well known that at the end of the 70s, the thrift industry was on the ropes because of rising interest rates, and the thrifts had their money invested in long-term mortgages. And as interest rates on deposits rose, people took their money out of thrifts and put them in money market funds, banks, and other agencies that give them a higher return. So now thrifts were carefully regulated and had been all throughout their history. They were designed just for single-family homes, basically. Well, in 1980, the first step was taken, and that was to lift the cap on interest rates and raise the amount of insurance for each depositor to $100,000. Okay, now that one's pretty well known. Now, in addition, right around that time, because the thrift industry was in so much trouble, the regulators began to grant what they call forbearances. Now, part of the regulatory apparatus was that each thrift had to maintain a certain amount of reserve money on hand. It was calculated as a percentage of assets. Assets being outstanding loans and any property or any other asset that the thrift owned. And they had to maintain 5%, which means that if the thrift was liquidated on a given day, they had to have at least 5% left. Anything under that, and they were in violation of the rules, and technically they were insolvent. They could be closed. But because the whole industry was in trouble, the regulators took it easy on them, and they granted forbearances which allowed them to carry a lower capital reserve than the law required. Now, what that effectively meant was, if you were a thrift owner, and that 5% capital reserve was really your profit, because if you liquidated the thrift on any given day, what was left over was what you took home. So, in the early 80s, with these when the thrifts were in trouble, many of the thrifts had no capital reserve, which meant that the owner had no more stake in the thrift. He had already lost his money, see? So
anything that he could grab then, in any way, was his.
And turn into assets that could be personal or corporate that he could control outside of the framework.
And so then it meant that he really had no loyalty to the organization.
Exactly. Because he had no money in it. He had already lost his money.
Okay.
So,
and this began actually with Carter, or when Reagan first came in as president?
Well, the problems in the thrift industry began in the 70s, and it dates back to us going off the gold standard and floating interest rates and all of that.
It goes back to Nixon, really.
Exactly, right. 71.
And then the high inflation under Carter and high interest rates.
Exactly.
And they forced them to give a lot of money. I was getting 17% at one time for money market thrift certificates.
Prime rate got up over 20% at one point in 78, I think. So there's a point about the psychology here. The regulators were giving everybody a break because they didn't want to have to shut it all down. They didn't have enough money in the insurance fund to cover all these deposits anyway.
The FSLIC.
The FSLIC, right. So the owners were kind of set up already psychologically. Now in 1982, the famous Deregulation Act occurs, and that's Garn-Saint-Germain. We've all heard of it.
We've talked about that, all the skullduggery and corruption that went on in that.
Right. Well, let me just go through a couple of the provisions of Garn-Saint-Germain and show how they had the kind of effect they had. First of all, they dropped the capital requirement from 5% to 3%. Okay, so that meant your reserves had only to be 3%. Now, that had an interesting effect, particularly with the people that wanted to buy in. Okay.
They didn't need as much.
They didn't need as much. So if you had a $100 million bank, a medium-sized thrift that was up for sale in a small town in Texas, for example, all you needed to come up with was $3 million to buy that bank, and you set that aside as a capital reserve, and you were off and running.
And some people bought some very big banks with even less than that.
Yeah, well,
there's some famous stories of this Florida guy.
Exactly, with promises that they were going to make it up, and they had investors and all of this. Now, another interesting part of Garn Saint Germain was it allowed the banks to take 6% loan origination fee on any loan they made. Now, what that means is that you go into a town, you buy a $100 million bank, you put up $3 million. The next thing you do is you loan that $100 million out, and you take a 6% loan origination fee, and you just put $3 million in your pocket.
So you're being paid to loan money to whoever. Exactly. Any shady wheeler or dealer, you're going to get
your
6% fee,
front,
and the government will insure the loan if it goes bad.
Exactly, and you took it up front.
So you're encouraged to give bad loans by this bill.
In a sense, yes.
And they didn't make any difference to them if they were paid back or not, because they had their 6% up front.
Exactly. Okay. Now, the, savings and loans were allowed by Garn Saint Germain to branch out into all kinds of investments. In fact, they were allowed to invest directly in commercial real estate projects. So what they all did was, the minute Garn Saint Germain was passed, they all set up a holding company, a construction holding company, sort of off to the side. And then they would loan money to the construction company, and the construction company would go ahead and develop property. So the first thing they all did was they designed office towers. And they counted on themselves to be a primary tenant. So they built themselves buildings. Okay?
They loaned themselves money, built themselves buildings.
Right, and then they charged themselves exorbitant rent.
Which came out of the deposits
exactly.
of the savings and loans.
Exactly,
right?
exactly.
And they could take it as profit.
And their loan fee they got on top of all the rest of it.
Exactly, exactly.
God.
Now, another thing they were allowed to do, and this is, I mean, just gets more and more incredible, 100% financing. So, borrower comes into your bank, he's got this project he wants to do, he needs $50 million. Well, they never asked him what he was going to give him up front. They just said, okay, we'll lend you the $50 million. They didn't have to put up a dime.
They didn't check to see if the guy had credit worthy or
well, they were supposed to check that. It was called due diligence, but it was left for somebody else
diligence
to
was lacking.
Exactly. And as part of the deal, they would loan a little extra. Like if you wanted $50 million, they would loan you $58 million. They'd set the $8 million aside in an escrow account to pay off the interest the first year's premiums.
Oh my God.
Right? So the developer never put in a penny. The bank loans out the $50 million. Right? The payments are made on time. They're just pulled out of the escrow account that the bank also loaned as part of the deal. Right? So the developer didn't have to put up a penny.
So this encouraged a lot of development that wasn't needed. I mean, already Houston, for instance, had about a 50% vacancy rate on their office buildings, right? And throughout Texas, this was the case.
Exactly. Now, and there's a lot more.
And here in Austin, we got all these buildings that nobody's in.
Oh, yeah, exactly. Now, there's a reason for that, and I'm getting to it. Okay. There's one other point I want to make about Garn Saint Germain.
All right.
And this is really a killer. They were allowed to loan money on the appraised value of a piece of property. Not on the purchase price, on the appraised value. So,
who is appraising?
Well, you go around town, you get an appraiser, but of course the appraisers are going, you know, they listen to the tone of your voice. You know, and if you're telling them you're going to build the Taj Mahal, you're going to cover it with mosaics this big, and it's going to cost $100 million. Well, you know,
suddenly that's the price.
Exactly. So, I mean, you bought a piece of land for $5 million and you're going to put a $100 million development on it, then $100 million was the appraisal, and that's how much you could loan out.
And was the appraisers getting kickbacks, or were they getting percentages based upon the appraisal?
Of course.
That's standard fees, right?
Exactly. So, okay. Now, here comes a big kicker. One of the very first things that Ronald Reagan did when he got into office was he pushed through the Tax Reform Act of 1981. Now, there were two major clauses of this Tax Reform Act. One was it dropped the tax rate for the very wealthy, the highest bracket, from 78% to 73% to 28%.
That's a big drop.
That was a big drop. Freed up a lot of bucks. The second thing that it did, and this is the important thing for the savings and loan industry, is it changed the way depreciation worked. Now, when you buy commercial property, you're allowed to depreciate that property over the average length of existence of that property. So, for example, if you buy a building for $1 million and it's got a 20-year life, let's say, then you can depreciate the value of that property 5% every year for 20 years. Okay, which means that you can write that off your taxes. You take it off your gross income. Well, the Tax Reform Act of 1981 allowed for accelerated depreciation. So, instead of 5% every year for 20 years, you could write off 12% the first year, 10% the second year, 8% the third year. So in 3 years, you've dropped 30% instead of 15%. Okay? Now, what that meant was that you could get an enormous tax break. In fact, most of the people who invested went back and refigured their taxes 3 years in advance and took tax breaks on that too. So they made a fortune.
So they're deferring tax payments, right? They're waiting to the future to pay the taxes on it, and they're getting their deep discounts early on? Is that the way it worked?
Well, when you're allowed to depreciate the value of the property, it means that, yeah, you pay less tax at the beginning and more tax later on.
Okay. So it's deferring the tax.
Yeah, exactly.
Okay.
Of course, they all plan to sell the properties after 3 or 4 years.
So they wouldn't pay any taxes.
Have to pay any, right, exactly. Right. So what this did was everybody wanted to build. Everybody wanted to develop, right? So, as you were saying, all of that development, all of those properties were not built to put people in their offices.
To meet needs that people were demanding.
There was no market demand whatsoever.
Right.
It was a place to put your money, and it was an enormous tax shelter.
Right.
Okay. Now, this is going to come back to haunt people. Okay. Now, there were some other changes. There were changes in the appraisers' laws. One key one was something that always troubled me was in 1983 and 1984 here in Austin, along Congress Avenue, our main avenue, all these office towers went up all at once. You guys ever notice that?
Yeah.
Okay, and it always bothered me. I mean, why was everybody building at once?
And all postmodern style.
Well, the reason was that the rules for appraisers were changed. Now, normally, if you put up a property, the appraiser would have to take into account the surrounding properties. So in other words, if you put up a luxury apartment building on a block with 4 other luxury apartment buildings, it's worth less than if it sits by itself, right? Naturally, market value. Well, under the new appraisal laws, appraisers did not have to take into account any building in the area that was under construction. So in other words, when they appraised one of those towers on Congress Ave, they didn't have to take into account the fact that there were 5 other towers being built right on the same street within a few blocks. Okay, so that the market value was completely inflated for all of those towers. Okay, now you couple that with the fact that you could loan on appraised values, and I mean you had an inflation that went through the roof. And people began to do things called land flipping, where they would buy a property. I'll give you an example. There's a guy named Louis Reese from Dallas.